So good evening. Today, we are going to be looking at a new topic, which is like a follow-up from the last topic we just finished, which is financial instrument. And the topic is IFRS 13 on, on fair value measurement. That's the topic we want to look at today. So this standard has been around for a long time, and the way it came out around is by a joint effort between the IASB and the FASB. The FASB relates to the standard body governing the United States. So they came together to form and harmonize a standard on fair value. So basically, what we'll look at in the next 30 minutes, this topic or standard will not take us 30 minutes. What we want to look at is we're going to understand by definition what fair value is. And also, this standard, its major objective is to set out a single framework for measuring fair value all over, and also the disclosures relating to fair value. So first, when we say fair value, what do we mean? Looking at this standard on IFRS 13, this standard defined fair value as the price that would be received to sell an asset or paid to transfer a liability, not to settle a liability, but to transfer a liability in an orderly transaction between market participants at the measurement date. This is a definition that is generally adopted and acceptable for fair value now. There used to be a previous one that we used to have before we had a single or a separate standard on fair value. We used to define fair value as the amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties in an arm's length transaction. That was the definition we used to have before, but now it has changed. The definition we have now, the main focus of this definition is the price that would be received to sell an asset or paid to transfer, not to settle a liability, but to transfer, because transfer is bigger and wider than just settle. There are a lot of ways in which you can extinguish a liability. It's beyond settlement. Learn that under financial instrument. So fair value is the price you would receive to sell an asset or pay to transfer a liability. You see? So the key word is exit price, which I will still get onto very soon. So this definition is synonymous to the definition of fair value in the United States GAAP, right? And so now we no longer have the terminology arm's length transaction anymore. It is gone. And now replaced with exit price, a market-based current exit price, which retains the notion of knowledgeable, unrelated, willing parties as well. That's the definition, and we're going to spend some minutes on this definition when I get to how to determine fair value itself. We'll spend a few minutes there explaining it critically and further. So you see, this standard now, like if you look at the objective here, the second objective or what this standard is actually set out to achieve is to set out a single IFRS framework for measuring fair value. So what I wanted to do, in fact, the aim of this standard is to ensure that we calculate fair value the same way. All standards, all accounting standards should make reference to this IFRS 13 whenever they are talking about fair value. So they want it in a way that it's IFRS 13 that would dictate how we determine fair value. That was the objective. Now, however, there are certain standards, even though we have a single framework for fair value measurement, but some standards are left out to deal with fair value in their own rights, and one of them is IFRS 2 share-based payment. And definition of fair value in IFRS 2 is quite different from here because IFRS 2 also deals with fair value of share options. Okay, that's outside the scope of IFRS 13, because IFRS 13 deals with the price that will be received to sell an asset or paid to transfer a liability. So it deals with asset and liability. So we left IFRS 2 to deal with fair value of share options and shares, right? So whenever we are talking about determining fair value for those ones, IFRS 2 will take care of that, the principles in IFRS 2. And also, if there are fair value applicable or required in IFRS 16, that is also determined in line with IFRS 16 as well. Is not covered here. And also determining net realizable value in IAS 2, as well as determining net realizable value in IAS 36. They are outside the scope of IFRS 13. Also, when we are making disclosures about fair value, we have scoped out any fair value determination concerning IAS 19. Let IAS 19 take care of those fair value of plan asset and fair value of the present value of defined benefit obligation. Let them take care of that. Is none of IFRS 13 attention here. The same thing as IAS 26 and also IAS 36. So most of these standards we have mentioned here, they deal with fair value based on their own standards. So any other aspects of fair value, like when we are talking about fair value relating to those financial instruments I taught you, or you want to determine fair value for items like PPE or intangible assets or investment property, those ones, IFRS 13 will come up and take care of those ones. But anyone that falls within these ones I've mentioned here, they are dealt with in each of those standards, like IFRS 2, IFRS 16, IAS 2, IAS 36, IAS 19. Let them take care of determination of fair value in their own standards. So how do we then determine fair value? How do we then determine fair value? So I'll teach you a standard way, looking at determination of fair value by the definition of fair value. We can easily know and understand how to measure or determine fair value from that definition. And you see, historically, fair value has had different meanings depending on the context you are talking about it and usage. But we are beyond that now, because with the definition of fair value now, I mean, our attention, our focus regarding the understanding of what fair value is now narrowed. Because looking at this definition, again, it says fair value is the price that would be received to sell an asset. So whenever we want to determine fair value of an asset, I mean the one that is within the scope of IFRS 13, like PP, like intangible assets, like financial assets, whenever you want to determine their fair value, the key question is how much would you receive to sell? So the price that would be received to sell, that if you sell this asset today, the price you would receive, that is the fair, that's what we call fair value of that asset. And when you're talking about liability, is the amount you would pay to transfer the liability, to derecognize the liability. That is also the fair value of that liability. But this transaction, regarding the price you receive or the price you would pay in case of liability, this transaction must happen in an orderly transaction. You will see what that means very soon. And it must be between market participants, and it must be at a measurement date. So the determination of fair value is always with reference to a measurement date, meaning that the fair value of an asset today might be different from the fair value of an asset yesterday or even tomorrow, because we need to know the date when you determined that fair value, because fair value is not static. It's at a measurement date. It changes every day. It changes every day. So basically, looking at focusing on assets majorly, because that's what I'll be mentioning often and often, more often, yeah. Focusing on assets, you will see that before you can determine fair value of an asset, that means you have to sell the assets. Even if you're not selling, you must assume that how much would you receive if you sell? You must look for somebody that have sold a similar asset and see how much the person received. So fair value, first thing is that it must be an exit price in determining fair value. So for you to measure fair value, you have to be exiting either the assets or the market. You must exit it. You must sell before we can determine fair value. Now, this definition is so clear that it can originally guide us. It's so explanatory that we can easily use that to always determine fair value. But there are key things we need to note here. Because when we say that the fair value is the price that would be received to sell an asset, does that mean that at every point in time, when you receive money for an asset, would that be a representation of the fair value? It might not be, because it could be distorted, right? So for us to properly determine that, okay, this price you have received is fair value, the first thing you must pay attention to is that you must understand market assumptions or assumptions made in the marketplace. These assets, when you are determining the fair value of these assets, the circumstance relating to that sale must must be very original, that you must have made assumptions that people in the market will have made. For example, now, and these assumptions we are actually talking about will usually surround probably the characteristics of the assets. Because when you are selling an asset, the price you would receive should vary depending on the characteristics of the asset you are selling. The assumption that market participants would make, it would usually be affected by the type of asset you want to sell, the characteristics, because the price you would receive for example, a very new asset that you have not used for so long should not be the same as the price you will receive for an asset that you have used for so long, or the price you will receive for a an asset that is more recent, that everybody is using right now, that is the talk of the town, will be different from the price you receive from the one that is outdated. So the characteristics of the assets must determine the price you are going to receive for that asset, and also is the location and the condition of the asset. Because the assumption market people would make, that's why they said it has to be between market participants. It's just to ensure that this price you are saying you are receiving, is it actually the fair value? So one must consider the characteristics of the asset, and that you would see the price that is received, is it the fair value? Another one is the location and the condition of the asset would also determine the fair value, and would also determine the assumption that would be made by market participants. And a lot of things will be considered, but I'm just summarizing all of these things just to be sure that don't just assume that I should be have sold it and this is the price I received. So that's the fair value. Yes, that's the price you received when you sold, but it might not be the fair value if the assumptions, if the conditions surrounding that sale would, that a reasonable person will not give you that kind of money for that type of asset. So we are saying that the assumptions surrounding the price you received must be the one that the market would make, that a third party would be ready to pay that kind of money for that asset. Then we can say that, okay, that's fair value. So some of the things you will consider is, okay, what was the characteristics of that asset? What was the condition of that asset? What was the location of that asset? I mean, if you want to get fair value of an asset, like let's say building, just for me to explain location. The price you receive for an asset in Magodo cannot be compared with the price you receive for an asset, let me say, in Eco Atlantic, even though the square meters, let's say, is land, even though the number of square meters are the same, but they would be determined by the location of that asset. And we can continue to really talk about these things, but we need to be sure that it's not all prices that you receive that will represent fair value. Um, the assumptions that are surrounding that price you are receiving must be the assumption that is made in the marketplace. And also, another one in this definition is orderly transaction. Still talking about the price you receive for an asset. For us to know that that price is the fair value, it must be in an orderly transaction. And when we say orderly transaction, one thing about orderly transaction is that it must not be forced. You must not be in a situation where you are desperate for money. You now want to sell the asset, that you are ready to collect any amount. That is not orderly. You must not be pressed for money. In the sense that before you can say a transaction is orderly, you must have, the asset must be in the market for like a good number of periods, like months. There must have been marketing activity. There must have been competition among or in the marketplace that different people are coming to bargain. I mean, there must be like good and orderly transaction around that assets. Then we can say that that transaction is orderly. It's not the one you just rush, you are desperate to sell. No, there must have been marketing activities. There must be competitive force. People must have bargained and all of that. Then that is orderly transaction. Then, if it's orderly, then we can say that then that's the price you receive. And very importantly, before I forget, when the price you receive also can never, you cannot remove transaction costs from the price you receive if you want to get fair value. Please note this because you need it. I can't like asking this. Fair value does not consider transaction costs. Transaction costs, like probably maybe you want to sell an asset. You now had to involve, let's say, a professional that will do some work on the assets before you can sell it. We call that some transaction cost. You see, that transaction cost, you say don't deduct it because that is not a characteristics of the assets. As far as the asset is concerned, you want to know what is its fair value. So you will not consider it because transaction cost is very difficult to estimate and determine because it could be subjective in most instances, right? And we see it as characteristics of the transaction, not of the assets. What we consider when we are determining that the price you receive is the fair value is the characteristics of the asset, not the characteristics of the transaction. So we don't consider items like transaction. The only one we might consider is probably, let's say, transport costs, where you have no choice than to carry the asset down to where the person will buy it or where you want to sell it. Yes, that one is okay. But any other one that you have to incur on top of that, even though others will argue that it's selling costs. No, it's a direct, that one for us, according to IFRS 13, is a characteristics of that transaction because it varies. It depends on the kind of person you engage. You see, some people, when they want to sell an asset, they will engage some professional that they will say, okay, ours is 10%. Some people say, just give us 100,000. So, I mean, we don't want that when we are determining fair value. We want to know what is the fair value based on these assets. You don't want to consider other things beyond the assets. Whatever transaction that you have entered into to sell, it's up to you. Don't remove it in determining the fair value. Fair value here is different from net realizable value. No, we want to know what's the fair value of these assets. So this definition can go on and on just to ensure that we determine fair value. And again, the unit of accounts we are talking about here is relating to the type or nature of the assets. Different standards deals with different types of assets. Like if the asset is building, for example, now, that's a unit of account. If the asset is, let's say, If you want to sell your license, that's the unit of account. If what you want to sell is maybe a debt instrument, that's a unit of account, right? So IFRS 13 didn't really talk about that. Its focus is not that. Its focus is just how do you measure fair value? It didn't specify a particular type of asset. So each standard is left to individual standard to determine the type of asset or the unit. That's what they call unit of account that you're dealing with. Now, finally, using this definition, you see, the price you receive to sell an asset, for it to be a fair value, that price must have been received in a principal market. Again, the price you receive to sell an asset, the price, that price, for you to say that that price is the fair value, it must have happened, that transaction must have happened in a principal market. Now, so what is a principal market? A principal market here is a market where high volume of activity happens on that asset. That's a principal market where high volume of activity. Like if you're talking about assets like shares, for example, now, shares, when you want to buy or sell shares, the principal market is the stock market, the Nigerian Stock Exchange. When you're talking about assets like, let's say, phones or laptops, and the principal market could be, let's say, Computer Village. But the ideology for us here is that principal market is a market where there is high volume of activity or that has the greatest volume and level of activity on that asset. But there are certain assets that you might not have principal market for, that they are just different markets here and there. I mean, depending on the assets you're talking about anyways. So in that case, you should consider the most advantageous market. You should consider the most advantageous market. You see, the most advantageous market is the market which maximizes the amount that would be received for the asset. The most advantageous market is the market which maximizes the amount that will be received on an asset. So that means you could have like 5 markets that you can sell these assets. So the most advantageous market is the one where you received the highest money. Is the one where you can sell it for the highest price. That would be the most advantageous market. So, and that is it about how to measure fair value. You see, all this my explanation to you. We have not seen a question around it. It's a way of determining fair value, but it's not actually easy to determine fair value for all assets in that manner. So there are other approaches or techniques for determining fair value, which we're going to look at very soon. But this is a way, looking at this definition, the price that would be received. For it to be fair value, I've mentioned a lot of things: characteristics of the assets, condition of the assets, location of the asset. I mean, you have to ensure that that asset is happening in a marketplace and you're dealing with a market participant, that the assumptions made in determining that price you received is what will be made in the marketplace. And I talked about orderly transaction, right? There must have been marketing activity, there must have been competition. You must give it time to ensure that the asset seeks in, people know about it, then you eventually sell it. And that price can be a fair value. And also, the price, you must receive it in the principal market, which is the market where there is high volume of activity on that asset. If there is no principal market, then you'll be talking about the most advantageous markets, which is the market where that will give you the maximum return on that asset. Okay, so that's determination of fair value. Now, you agree with me that if we were left to determine fair value in that manner, there would be serious challenges, because this process I've just explained is a complex process. So IFRS 13 actually set out an effective way, rather than just definition and basing that in determining fair value. Then it gave us some valuation approach, that instead of looking for principal market, most advantageous markets, orderly transaction and all of that, so why don't you use a valuation approach depending on the assets that we are considering? So there are three approaches. So I kind of asked this severally. It's so easy to ask. So there are three approaches for determining fair value. There is the market approach, there is the income approach, and there is the cost approach. And which this one of the three is what you find most companies use in most of the financial statements, where in the accounting policies you will see that they will tell you that we use the income approach, we use cost approach, like that. So the income approach is just determining, they will convert future amounts to a single current discounted amount. So it's just similar to how we determine value in use, right? Whereby they would estimate how much we can make from this asset for the periods we are going to use it. Then they will discount all that to present value. That gives whatever value we get, we see that as the fair value of these assets. We call that income approach, right? And there's another one, which is market approach. And what this does is just to use the selling price. You will just get the selling price of that asset. I mean, by whatever market transaction that has happened in the past, or for one any similar person has engaged into. So they will get it, and they will use that as the fair value. That they call market approach. So focusing on the selling price of that asset. And this market approach keeps it simple. You don't have to define principal market, whatever. So it's generated by market transaction, whether from an identical or a similar asset that has happened before. The price is there. You can use that as the fair value of your asset. That's market approach. And there is the cost approach, which is just the replacement cost of that asset. Like if I'm going to replace this asset today, if I'm going to buy another one today, how much will it cost me? And you can use that as the fair value of that asset. So these approaches keeps it simple. And I can ask you this for 4 marks, that what are the valuation approaches in line with IFRS 13? And you also give the solution to them in a very simple way. Don't write thesis or unnecessary details, because they are very straightforward. Income approach is just the present value of future cash flows. The market approach is just the prices by market transactions, or in a market transaction involving identical or comparable assets. Why the cost approach is uses the value or the current replacement cost of the asset. And those are the valuation approach we have. Now, you see, another one is when you are measuring fair value using any of these approaches, you will see that each of them, like this one now, the main point for this income approach would be your future cash flows. That's the input you will need. That's the data you will need. For this one, the data you will need is the prices in a similar market transaction, right? For a similar asset. I mean, you need selling prices. While cost approach, you need current replacement cost. So we call these inputs. So in order to prioritize this approach, they actually gave us 3 levels of hierarchy based on the type of inputs to the valuation technique. So they want to prioritize and place level of importance on those valuation technique based on the type of input you are using. So what they are saying here is this, that there is a level of hierarchy for the input you use to determine fair value. Again, there is a level of hierarchy, level of priority, level of importance that is placed on the input you use to determine your fair value. The most important one that we prefer, that we want you to use, we put those ones as level 1. That's the hierarchy, level 1 inputs. And this level 1 inputs is where you would use unadjusted quoted prices in active markets for items identical to the asset or liability being measured, right? So unadjusted quoted price, that's level 1. So if that is what you use to determine your fair value, then that's the best unadjusted quoted price. So that is if there is a quoted price in an active market, then you would get your fair value without any adjustment. That's the best. So, like for example, now, if you need to get the fair value of, let's say, First Bank, is everywhere. Just get their market price on the stock market, right? That is an unadjusted quoted price. Is there, right? And when I say active market is a market where there is pricing information, there is frequency and volume of activity is high, that everybody knows the price. Okay, so that's level 1. Now, you see, the determination of whether fair value should be level 2 and level 3 is determining whether the additional inputs or other inputs you use are observable or unobservable. That's what distinguishes between level 2 and level 3. So level 2 now is where the input is observable. And when I say observable, is like a situation whereby you have to use an input that is not quoted price. I mean, it's not every asset that would have its prices quoted. Like for example, now, you want to get the fair value of, let's say, Glow. Their fair value is not quoted, but you can use the fair value of a similar company in the same industry, like MTN. Okay, but you cannot just pick the price of MTN and say, okay, yeah, this should be the fair value of Glo. No, you will need to make some adjustments. You will need to make some allowances because the business risk and financial risk they are exposed to are different. They have different managements, even though they have almost similar customers, they operate in the same economic environment, but they're different companies with their profitability history is also different. So we need to make some adjustments. So when you have to make adjustment to a quoted price, a price that is observable, that everybody can see, that everybody knows, but is not the price of that asset in question, but a price of a similar asset, it requires adjustment. That is level 2, but it's observable. It's good because IFRS 13 prioritizes using observable inputs. Then level 3 is where you use unobservable inputs. So for level 3, IFRS 13 says that you should just stay away from it if possible, minimize it, because it says entities should maximize the use of observable input and minimize the use of unobservable input. So we don't want you using unobservable. And what do I mean by unobservable? So it's a situation whereby we cannot get a quoted price for that asset. We cannot get a price of a similar asset. Then that means you have to now use the company's data. Like the relevant input you have to use will be developed internally, right? And majorly that's a situation where you are using an income approach. Majorly a situation where you're using an income approach. That's income approach is level 3, almost in all cases. So that is where you would estimate future cash flows, then you discount them to present value. So when you're using the company's data, majorly cash flow forecast, then to determine fair value, that's level 3, is unobservable because whatever value you use, it's not verifiable by any third party. It's your data. Is either your sales data or or um or the company's data, right? So that's level 3, and that is it around determination of fair value. Now, so furthermore is when it comes to non-financial assets. When I say non-financial assets, I mean assets like PPE or intangible assets. Those are non-financial assets. So when you are determining their fair value, like land, plants, motor vehicle, and all of that, when you want to know what their selling price is, the price you can receive when you sell them, we would need to consider something we call highest and best use of the assets. Highest and best use. So, of course, as determined by market participants. So, the fair value will be determined based on the highest and best use. So, is whatever valuation you are using we need to focus on the best use of that asset. And of course, for most companies, right, they would have been using that asset for its best use already. Okay, but theoretically in your exams, you need to have this at the back of your mind that when it comes to non-financial assets, for us to get that price you will receive when you sell it, the valuation must be based on the highest and best use of that asset. Furthermore is that this use, whatever it is you are using this asset for, that is, in determining the highest and best use, it must be a use that is physically possible. I mean, it must be something you have tested and you have seen that, okay, this asset can be used for. It's part of the characteristics of these assets. It's something it can do, physically possible. It must be legally permissible. It must be a use that is legally permissible. Otherwise, it will not work for us. And also, it must be a use that is financially feasible. It must be a use that will generate adequate return for market participants. Then, when it meets these three key areas, then that's the highest and best use. And that is that we need to focus on in determining the highest and best use. So the last time I can ask a question on this, so just for 2 marks, and all you just need to tell them, you're just asking that what do you need to, how do you determine the fair value of a non-financial asset? All you just need to tell them is this I've just told you now, right? So you must consider the highest and best use of the assets. You must consider, and this highest and best use must be physically possible, legally permissible, and financially feasible. Okay, so I'm done with explanation on Ifrs 13. What is remaining now is for us to solve questions. So before I start solving questions, do you have any question, or we just jump into solving questions immediately? Okay, so let's read this question. So they said an asset is sold in 2 active markets, market X and market Y, 58 naira and 57 naira respectively. So they are sold at 58 naira in market X, 57 naira in market Y. Okay. So Wadex does business in both markets. I can assess the price in those markets for the assets at the measurement date as follows. So we have market X and we also have market Y. And these are the relevant prices that we have. Price, transaction costs. We have the transport cost as well. So we are now asked that what is the fair value of this asset? So without even looking at the solution now. So since they gave us market X and market Y, the question just says that what is the fair value? From here, the first question you need to ask yourself is, because I've given us all the details that I was explaining to you the other time, that the price you receive, is it the fair value and all of that? But this question has given us the price, the selling price of this asset already. So I can say that this is the fair value. Just that the only thing I told you, that when you're determining fair value, don't deduct transaction costs, but you can deduct transport costs. Don't deduct transaction costs, but you can deduct transport costs. But the core thing is this: which of these is the principal market? Because the fair value must be determined in the principal market. But this question didn't tell us which of them is principal market. Of course, in the exam, they will tell you, because this is just class. So we can just assume that if market X is the principal market, then my fair value would be 58 naira minus transport costs of 4 naira. So my fair value is going to be 54 naira. That's if market X happens to be the principal market. But if it is market Y that was the principal market, that means my fair value will be 57 minus 2, and that will be 55. And that 55 is my fair value. So always have it in mind that when you want to get fair value in a principal market, don't deduct transaction cost. Don't deduct transaction cost. Okay, and that's what I want to use this question to teach you first. That's principal market. The second one is this. Let's assume that they told us, in this question, they did not tell us. Let's assume that they told us that neither of these markets, neither of them is the principal market. That means that you now have to consider the most advantageous market. The most advantageous market. And I told you that since if the question had told us that, okay, neither of these markets is principal markets, then the next question is which of them is the most advantageous market? And I've told you that the most advantageous market is the market that maximizes the return you get on the asset. Is the one that would make you get the highest profit. That's so the first challenge is this. Which of these markets is the most advantageous market? And very straightforward to identify. This market X, after deducting all your expenses, you get 15 naira. Market Y, after deducting all your expenses from the price you received, you get 52 naira. That goes to show that market Y is the most advantageous market because it's the one that gives you the maximum return. Now, having determined that market Y is the most advantageous market, then our fair value will now be determined in market Y. Our fair value will now be determined where? In market Y. So what is our fair value? Our fair value in this market Y is 57 naira minus 2 naira. And that's 55 naira market Y. So the fair value is 55 naira. So this question is an open question. I just want to use figures to explain those things that I was talking about, principal market, don't consider transaction cost, and all of that, most advantageous markets. This question does it for you. Any question, everything I've just explained, I've actually explained it here anyway, so you can actually see it there. Any question before I move to another question? Okay, so let's move. So there are disclosure requirements here that you can look at. So you will need to, when you are disclosing, you need to tell us the evaluation techniques that you used and also the inputs that you have used. And also you need to tell us which of them, if you had used unobservable inputs, you need to tell us what was the effect on POL or OCI, because using unobservable input is something we do not encourage. So you need to tell us the basis. You need to tell us the basis you used in determining those inputs you have used. So majorly, those are the disclosure requirements. And furthermore, I have advantages and disadvantages of fair value here for you that you can look at your leisure time. So I can have actually asked this before anyways. Advantages of using fair value, disadvantages of using fair value, and also advantages of historical costs, as well as disadvantages of using historical cost. So let's solve this I can pass question of May 2021. So they said that fair value is a market-based measurement, not an entity-specific measurement. I mean, you have explained that before, that you need to assume that market participants, what decision would they have taken? How much would they have paid for this asset? It's not entity specific. It's not about you, about the market. It's the market that determines fair value. So, and fair value focuses on assets and liabilities, and also on exits, and also on exit selling prices. It also takes into account market conditions and the measurement dates. So in other words, fair value measurement looks at the amount for which the holder of an asset could sell it and the amount which the holder of a liability would have to pay to transfer it required. Discuss the view that fair value is a more relevant measure to use in corporate reporting than historical costs. So this one is just asking you for the advantages of fair value, so which you can look up there. So for you to make up these 4 marks now, you can give them advantages of fair value, of course, which will constitute like the disadvantages of historical cost. It's just to discuss and explain to us why fair value is more relevant than historical cost. Then the second one says we should discuss the valuation techniques in fair value measurement in accordance with IFRS 13 for 4 marks also. And I've taught you the valuation techniques, the income approach, the cost approach, and the market approach. But even though they ask you to discuss, so that means you just give them short notes on income approach is the present value of future cash flows. So they use that. Whatever you get is the fair value. The market approach is just the price of a similar asset in a market transaction. So that's the market approach. While the cost approach is just the current replacement cost of that assets. That will constitute the market, the cost approach. 8 marks. Then the B part. This says that Bakhtari is a public limited company that is reviewing the fair valuation of its assets in line with the provisions of IFRS 13 on fair value measurement. The company has assets that are traded in different markets and is uncertain as to which valuation to use. So the assets have to be valued at fair value under international financial reporting standards. Bakhtari PLC currently only buys and sells the assets in market C. The data relating to the assets are set out below. So, okay, so what's this saying? They said Bakhtari is reviewing fair value of its assets in line with IFRS on fair valuation. The company has assets that are traded in different markets and is uncertain as to which valuations to use. Okay. So the assets have to be valued in line with IFRS. So they said this guy currently buys and sells these assets in market C. Okay. The data relating to the asset are set out below. So there's market A, market B, and market C. Okay. So that's year ended. So they gave us the volume. They give us the volume. They give us the price. They give us the cost of entering the market per unit, and they also give us the transaction cost. So we're now told that we should explain the 3 levels of hierarchy for fair value measurement using IFRS 13 for 6 marks. So that would be level 1 inputs, which is unadjusted quoted prices in an active market. And they said explain. So you could just give them, you could explain by giving them examples. Like if you want to get the fair value of the price of shares, for example, now that's quoted in an active market like the Nigerian Stock Exchange, the selling price or the share price of those shares, level one input. Level two inputs, which is observable inputs. They are observable inputs, which are the quoted prices of a similar asset. Okay, the quoted price of a similar asset. Just that this, for you to use this, you will need to adjust those prices. So it becomes adjusted. So that's level two inputs, and there's the level three inputs, which makes use of unobservable inputs. And these unobservable inputs are those that require the use of the company's data, like their cash flow forecast, to determine the fair value of an asset. That will earn you 6 marks. Then the two says that we should discuss with relevant computation how Bacteria should value the above assets for 4 marks. So how should he value it? I mean, whenever you see markets, different markets, the first question you need to ask yourself is this: which of them is the principal market? That's the first question. And in this case now, which is the principal market? The principal market here is market A. That's the principal market. Even though this guy buys and sells his assets in market C, fine, no problem. But that's not the principal market here. And the reason why market A is the principal market is because this market is the one that has the highest volume of activity on these assets. Is the one that have the highest volume of activity. And if you look at it, this market is market A, is one that has 12 million volume of activity. 12 million volume of activity. So now, having identified that market A is the principal market, then what is our fair value? Our fair value is simply going to be, hold on. I've done something like this before. Is there anybody here that can tell me what the fair value will be here in market A? Anybody? Anybody?
When they say cost of entering the market, is that transportation cost
No, that's
or
not
to
trans.
assess the market?
Is to assess the market. Probably you need to pay certain amount of money to become a member or to enter, something like that. It's not transport cost.
Because I was going to say 12 times 19. Okay, no,
Just
sorry, not 12 times 19. Market price per unit is 19 naira.
yes.
Transaction costs will exclude. The cost of entering the market is the confusion, the whether we should add it or not. 19 naira plus 2, 21 naira. The transaction costs will exclude transaction costs.
So if you sell the
So,
asset for if you sell the asset for 19 naira, that's the price you will receive. You will have to incur transaction cost, and you'll also have to incur cost of entering the market. I've told you that you don't remove transaction cost. So that one is out of it. So the key question is that should you remove 2 naira or not? Should it be 21 naira or should it just be 19 naira? So in this case now, because this company doesn't operate in market A already, before you can assess this market, it's just similar to transportation costs. they have to pay this cost of entering the market. It's a must. So these 2 naira would have to be deducted. So the fair value is 19 naira minus 2 naira. That's the fair value. So the fair value is 17 naira. So with that explanation now, let's assume the market we are considering is market C. Let's assume the market we are considering is market C. What will be the fair value in market C? The fair value in market C.
19 naira.
No, it's not 19 naira. It's not 19 naira. And the reason it's not 19 naira is because this company already operates in market C. There's a Bactari PLC currently buys, so he's already in the market, so he doesn't have to pay this cost of entering again. He already operates in this market. So for if the market were if market C happened to be the principal market, our fair value will have been 22 naira. Simple. Our fair value will have been 22 naira. Straight on. Because he's already in the market, he won't have to incur this cost anymore. So the only reason why market A consider this cost is because there is no information here that shows us that this guy operates in this market right now. So he would have to incur it. It's a must. Otherwise, he cannot sell anything. Now, another one I want to ask you. I'm done with this question, really. I've seen that the market A is principal market because it has highest volume. And the fair value is 19 naira minus 2 naira, which is 17 naira. I'm just using this one to revise. So let's say they didn't give us volume because it was because of this volume they gave us. That was why we were able to know which of them is the principal market. So let's assume they didn't give us volume, that they just gave us selling prices, cost of entering, and all of that. They just gave us that. So which market would we have used if they didn't give us volume?
That be the most advantageous market.
That's
I'll
correct.
see. Yeah, market
Yeah.
C.
Market C.
Yes.
Why?
Because that's where we get that's where we can maximize the sale on the asset, 22 naira. The company is already operating market C, so we will not be deducting 3 naira. That means the fair value be 22, which is higher than market A and market B, I guess. Yes, so yes, 22.
Okay. Well,
Yes.
good initiative, right? But for me now, I will have carefully calculated what's my return in market A. I will have done 19 minus 2 minus 1. And that's 16.
Because the okay.
That's
Because the
16.
maximization include both transaction cost and the cost of entering and any of the other costs, right?
Exactly.
Okay.
So the maximization is just determining your profit, considering all your costs. So this one is 16 minus 4, which is 12. This one is 22 minus 5, which is 18. So coincidentally, Deborah was right? So not because of her explanation, because she was considering 22 to determine the maximization. No, what you consider is the returns, the net return. So either ways, market C would have been the most advantageous market, which obviously explains why this guy operates in this market anyways. So, I mean, that shows that Deborah and Robert were following. I don't know about others. Now, the final question here, which is C part, it says Kantala Limited is a company based in Abeokuta, the Ogun State capital. It uses the revaluation model for its non-current assets. Kantala Limited has several plots of land which are unproductive. Okay, so this first paragraph is just talking about a company that has land and it uses the evaluation model for that land. And okay, so it has several plots of farmland and they are unproductive. Okay, unproductive. Paragraph 2. It says the company feels that the land would have more value if it were used for residential purposes. Okay, so if it were used for residential purposes, it will have more value. Paragraph 3. There are several potential purchasers for the land, but planning permission has not yet been granted by the Abeokuta Planning Authority for use of the land for residential purpose. Okay, so they have not gotten planning permission for residential purpose. Paragraph 4. However, preliminary inquiries with the planning authority seems to indicate that the planning permission may be granted. Okay. Additionally, the Ogun State government has recently indicated that some agricultural land should be used for residential purposes. Okay. So this paragraph is saying that it's very sure that they would even get our approval to use it for residential purpose. There's an indication of that already. Required. Advise Tantala on how to measure the fair value of the land in its financial statements. Okay, you see this question, nobody is asking you to calculate anything, obviously, because there are not even figures here. So how do you then advise him in measuring fair value? Simple is what I taught you on that non-financial assets, because land is a non-financial asset. So you just need to tell them that for Kantala to determine its fair value, you will need to consider the highest and best use for that asset. And this highest and best use must be the one that is physically possible, legally permissible, and financially feasible. Full stop. Next paragraph. From the case, the highest and best use of these assets is for residential purposes, as the present use is unproductive, which is farmland. So the highest and best use is residential. And considering the fact that there are indications that planning permits or permission will be granted for residential purposes, it shows that it is legally permissible. Therefore, the use that is of highest and best use is for residential purposes, and that should be the basis on which it should determine the fair value of the land. 2 marks, just 2 marks. And that's the end of fair value measurements. Any further questions? It's overdue for us to do IS 21. So it's a very interesting topic that we're going to look at very soon. But let's look at a simpler one.
If the government hadn't indicated that they will grant the permission to use it for residential purpose, then that particular condition would have stopped us from valuing that asset based on the residential use.
That's correct.
That's it, yeah. Okay.
Yes, that's absolutely correct. Impairment of assets. That means you need to grant me another 30 minutes. Use whatever internal energy you have to stay tuned just for 30 minutes. Then we'll be done by 10:15 or 10:20.
Sorry, I have a question.
Okay, all right.
Good evening.
Good evening.
So from the question, the last part says that the government is granting some. So on an exam condition, I may just be thinking, okay, so what if this one is not part of it? Or should I just assume that, okay, everything that is it's going to be legally permissible based on the last statement?
Well, you can say that also, but I think the way the direction of the question was going is already pointing to that they will grant it. Because so I won't want to just stress myself, students, and be overthinking this. The examiner told me that, okay, from all indications, they will grant it. They also told me that the government has even been granting some agricultural land for residential purposes. They told me that too. So whatever sum that I'll just ignore that and pretend as if I didn't see it. Because, and especially the fact that they now told me that, because if I don't use it for residential now, the farmland for agricultural, they say it's non-productive. So, in fact, the examiner wants the use to be residential. That's the direction the examiner is going. But good observations, anyway.
All right, thank you.
Yep. Okay. So 30 minutes. Let's kickstart impairment of assets. We might not finish it tonight, but I'm sure to finish it next week. I will just add it with maybe with IFRS 15, maybe IFRS 15. I will just add it to IFRS 15. That is also a theoretical standard. It's not so theoretical, but the funny thing is that I kind of been asking IFRS 15 back to back. I don't know. So we'll just do that with for finishing of IS 36. So IS 36, impairment of assets. So first we're going to look at objective, how to know whether an asset has been impaired, how to determine recoverable amounts, how to recognize and measure impairment loss, CGU and goodwill, reversal of impairment loss, and disclosures. So the objective of this standard is just to prescribe procedures that an entity applies to ensure its assets are carried at no more than its recoverable amounts. I mean, if I want to summarize this first objective is just saying that ensure as much as possible that the book value of your assets, the carrying amount of your assets is never higher than its recoverable amount. That is what this guy is out for, to ensure. The second one is that you then have to describe that asset as impaired when its carrying amount happens to exceed its recoverable amount, which is the amount you can recover through use or sale. I will still explain this in detail. I told you that the first objective is ensure that your book value is never higher than its recoverable amount. If it happens to be higher, describe that asset as impaired immediately. And also, we would is also to teach us how you can reverse that impairment loss and also disclosures. So, which asset are we looking at under this standard? Because if you remember, I've looked at impairment of financial assets before. I taught you that last week. So again, IS 36 now is talking about impairment of assets again. So which asset are we looking at again now? Obviously not financial asset again, but again, this one talks about tangible and intangible assets and financial assets. So there are certain financial assets that are not covered in IS 32. Those ones might be here, and it's very scarce. It's very, very scarce that I can really think of. Like we said, prepayment, for example, now we said is not under, it's not a financial asset. So mostly we would not deal with financial assets in IS 36. The focus is just tangible and intangible asset. And also inventories. Inventory will not be applicable. Deferred tax assets is not applicable. And also plan assets, we cannot impair them under IS 36. And also non-current asset held for sale, we cannot impair those ones also under IS 36. Those are scoped out from IS 36. So our focus on the assets we want to deal with here is just majorly tangible and intangible assets. That's what we want to focus on here. Now, there are key definitions we need to quickly know before I delve into the core principles. And the first one is impairment loss. So impairment loss is the amount by which carrying amount of an asset or cash generating unit exceeds its recoverable amount. The amount by which the carrying amount of an asset exceeds its recoverable amount. Don't forget, I told you that the objective of this standard is ensuring that the book value of an asset never exceeds its recoverable amount. So if it happens to exceed it, you describe the asset as impairment. So it's then very reasonable to say impairment loss is the amount by which carrying amount exceeds its recoverable amount. So two variables here. One is carrying amount and two is recoverable amount. So for carrying amount is the amount at which an asset is recognized after deducting accumulated depreciation and accumulated impairment losses. Jaron, that is carrying amount. That's the book value of an asset. So recoverable amount is of an asset is the higher of its fair value minus cost to sell and its value in use. The higher of the two, fair value minus cost to sell or cost of disposal. This fair value minus cost of disposal, that's what they call net realizable value. And there is value in use. So fair value that we just did today is the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. We already learned how to determine fair value. That's fair value. And value in use is the present value of future cash flows from using an asset, including its eventual disposal. So value in use is just synonymous to, okay, if I continue to use this asset, how much will I get? Like over its useful life, how much will I get? But we are more considered about the value today. So that means you will need to get present value of those future cash flows for us to be able to determine value in use. So these are key definitions that we would need. So the basic principle in IS 36 is is very straightforward. It's very straightforward. So we are saying that if for whatever reason the asset value in the account is higher than its realistic value, measured as its recoverable amount, if for whatever reason that carrying amount is higher than its recoverable amount, then the asset has suffered impairment loss. Reduce the asset value immediately in the books to its recoverable amounts. Reduce it because that's excess. That excess is an impairment loss. That excess is an impairment loss. And that impairment loss is usually recognized in profits immediately. Is recognized in profit or loss as an expense immediately. That's the core principle in adjusted receipt. That's all we want to learn here. That whenever the carrying amount is higher than its recoverable amount, that asset is said to have been impaired. And that impairment loss should be written off to P or L. So the thing I will just quickly talk about, I've used almost 10 minutes already, I have 20 minutes more. So what we want to really talk about first is, okay, how do you identify that an asset has been impaired? Because it's not something you do every year or every month. So what will have triggered you to start looking for recoverable amount up and down? Because the value you find is at almost every time is the book value or the carrying amount. That's what will be in your book. So what will have triggered you looking for recoverable amount that will now say that, okay, book value is higher than recoverable amount, then is impaired? I mean, how do you identify? How would you be triggered? What would have indicated that, okay, there might be a possible impairment loss? We need to quickly look at that. And thereafter, how do you then determine its recoverable amount? And how do you account for that impairment loss you eventually get? So in identifying impairments, whether an asset has been impaired, that we call indicators of impairments. Indicators of impairment. So that's how you identify. So which could be external indicators or internal indicators. So the external indicators, I mean, from external, you will know that these are mostly outside of the control of the entity. They are outside the control of the entity. And these external indicators are, one is fall in the asset's market value. Fall in the asset's market value. And this fall is more significant than would normally be expected from passage of time or normal use. When the market value of an asset falls, and that fall is significant, that you cannot attribute it to that, it's because we have been using it. That's why the market value fell. When you see that, no, this one is beyond that, then it could be an indicator of a possible impairment loss when there is a fall in the market value of the asset. Another one is a significant change in technological, market, legal, economic environment of the business in which the assets are employed. Of course, changes in technology, market, legal, economic environments can affect the value of an asset. Like most oil and gas companies that have oil depot, where they used to store their imported fuel or petrol, most of those assets might become impaired now with Dangote refinery coming upstream. So because now they don't have to import and store a lot. They can buy locally. They might not so much need that huge tank farm anymore. So that's a change in economic environment. It could be change in technology. I mean, the point is that these are indicators of impairment. Another one is increase in market interest rate or market rate of return on investment, likely to affect the discount rates used in calculating value in use. Value in use. So this increase in market rate now is pointing to the discount rate you use for your value in use. Remember, value in use require that you get present value of the future cash flows from an asset. So when you use a discount rate to get present value, the reality is that the higher that discount rate, the lower the value in use you would get. For most of you that have done NPV before, value in use is just similar to how you determine your NPV. The higher discount rates, the lower the NPV. So the same thing for value in use. So when there is an increase in interest rate that is used in determining your value in use, is an indicator of impairments. So like with the way CBN is increasing MPR, it's an indicator, because mostly when you are determining value in use, most entity will want to use the rates, which is the CBN rate. Another one is the carrying amount of the assets, net assets, the carrying amount of the entity's net assets being more than its market capitalization. So when this is particularly relevant for entities that are quoted on the stock market, if their book value becomes higher than their market capitalization, which is the share price times the number of ordinary shares, that's an indicator when your net asset is higher than your market capitalization. So these are external indicators. And there are internal indicators. And these internal indicators are, of course, the one within the control of the entity, like where there is evidence of obsolescence or physical damage. It's an internal indicator when the asset is damaged, or where there is an adverse changes in the use to which the asset is put, or the asset economic performance, where there is adverse change. So an asset that normally would generate that normally would generate or would output 1,000 units every day before, now is now doing 700 units every day. That is an adverse change, okay? Or an asset that you were using slightly before or sparingly, now you're not using it almost every day. That's an indicator. So when there is an adverse change in the use or adverse change in the economic performance of the asset, that is an indicator, internal indicator. And also, where there is a reduction in the asset expected remaining useful life, okay, that's also an indicator of impairment. So when the useful life has decreased, is an indicator of impairment. So these are internal indicators. Now, looking for indicators, there's a term we use for it. We call that impairment review. So if it happens that any of these indicators are confirmed that they exist, okay, then you have to move to the next step in determining impairments, which is you will need to test, then you will require to test the asset for impairment. The asset has to be tested for impairment. So that means the first stage is impairment review. The second stage is impairment test. And it is at the stage of impairment tests that we will then have to calculate recoverable amount. Now is where we trigger that, okay, let's go and get our recoverable amount, which is the higher of the net realizable value and its value in use. It is at the impairment test stage you do that. However, there are certain assets that even if there are no indicators or indication of impairment, you must still test them for impairment annually, even if there are no indicators. And there are two types of assets like that. Number one is an intangible asset with an indefinite useful life. An intangible asset with an indefinite useful life, you must always test them for impairment annually. And second one is goodwill acquired in a business combination. goodwill acquired. I know that Mr. Kazim has already started teaching you group accounts, so you must have heard of goodwill severally. So goodwill acquired in a business combination is also tested for impairment annually, every year. So that's indicators of impairment. So now, when you have determined indicators of impairment, okay, we have 10 minutes to go. So when you have determined indicators of impairment, then you need to test, which is impairment tests, where you determine recoverable amount. And I've already mentioned this before, so I won't go over it again, just so that I can move to another thing. So recoverable amount, I told you, is the area of fair value less cost to sell minus value in use. So I just try and explain it again, over and over again for you. So let me just move straight to a question here. So there's this question that says the company has a machine in the statement of financial position at its carrying amount of 150,000. The machine is used to manufacture the company's best-selling product range, but the entry of a new competitor to the market has severely affected sales. As a result, the company believes that the future sales of the product over the next 3 years will be 75, 50, 25. The asset will then be sold for 12,500. An offer has been received to buy the machine immediately for 120,000, but the company would have to pay shipping costs of 25. The risk-free market rate of interest is 10%. An impairment review confirms that the asset might have been impaired. Determine the impairment loss. Okay, so again, to determine impairment loss is just comparing carrying amount with recoverable amount. And from this question, we already have our carrying amount as 150,000. And then they said something around that sales is declining for the asset of for the company. And they gave us the future sales of the company for the next 3 years, which is this 3 for the next 3 years, and how much you will eventually sell the asset at the end of that 3 years. You see, this data they are giving to you is what you're going to use to determine your value in use. That's what you will use to determine your value in use. Then we're told that an offer has been received to buy the machine immediately for 120. This is the selling price of the machine, but the company would have to pay shipping cost of 2,500. This is the cost to sell. So, and they gave us market rate of 10%. So with this information given in this paragraph and the next paragraph, I can get my value in use and my net realizable value. So the carrying amount was given directly, 150, but the recoverable amount wasn't. So the recoverable amount was not. So I would just need to compare my fair value. I would remove my cost to sell, right? So that gives me 11,700. That gives me 11,700. Then also, I will then determine my value in use, which I will consider my net cash flows. Okay, my net cash flows. So I've seen a question in the exam which I can't remember the year, but it was very recent, where they wanted you to calculate impairment loss. So they gave you future cash flow. So they gave you pre-tax cash flow and post-tax cash flow. Pre-tax cash flow and post-tax cash flow. What would you have used? Is it pre-tax or post-tax? No time. So you will have used the post-tax. So after what we need is your net cash flow. After removing all whatnots, everything that you need is your net. So that diet, you just use your net cash flows to determine your value in use. So Since they gave me that my cash flow in year one is 75, and they already gave me the discount rate of 10%, that I will use to get my discount factor, which is 1 plus r raised to power minus 1. When you punch this on your calculator, it gives you this 0.909. If you multiply this 0.909 by 75, it gives you this figure, 68,182. So you do the same thing in year 2, year 3, and how much you receive when you eventually sell the assets, which is this. So multiplying each of them by their respective discount factors, you get their respective present value. If you sum all those present value together, you have 137,678. So now I have my value in use, and I also have my my net realizable value. My recoverable amount is the higher of the two. So apparently, my recoverable amount is 137,678. So having determined that and seeing that my carrying amount is now higher, that means this asset has been impaired, and my impairment loss is the difference, which is 12,322. 12,322. So that is how you determine recoverable amount, and that's how you determine impairment loss. Now, this impairment loss, this is the final thing for today, then we can go and sleep. So this impairment loss now, how do you account for it? How do you report it in the books, right? So if the asset is an asset where you measure it using cost model, using historical cost, you simply debit that impairment loss to P&L, debit it to P&L, and you're going to credit the assets. That's how you account for it. But if the asset is a revalued asset, whereby you measure it using a revaluation model, then you need to be careful. Careful in the sense that if there had been a previous revaluation surplus on that asset, then that impairment loss you are now getting this year would be debited to that revaluation surplus in OCI. In OCI, because revaluation surplus would go naturally to OCI. So when you now impair an asset, and this asset that you are impairing, there was a previous revaluation surplus on the same asset that's sitting in OCI. Then whatever impairment loss you are getting this year must go to OCI to go and reduce that surplus first. So if there's now surplus, if the impairment loss is more than the surplus in the previous year, then any excess can be going to P&L. But other than that, if there is a previous surplus on that asset, the impairment loss goes to OCI. You will go and eat the revaluation surplus in OCI debit, right? Then, of course, the corresponding credit still goes to the assets. Okay, I'm going to stop here for tonight, and believing that you are taking home the objective of impairment loss, and the objective is just to ensure that the carrying amount is never higher than its recoverable amount. If it does, the asset is said to have been impaired, and that is an impairment loss that we need to write off to P&L, hoping that the carrying amount that is excessive, that is overvalued, will now be brought down to its recoverable amount. And this recoverable amount is the higher between how much you can recover either from selling the asset, which is the fair value less cost to sell, or continue to use this asset, which is the value in use of the asset. And basically, that is what we have learned today. So next week, we are going to go advanced, looking at the term called cash generating unit and how it's applicable in IAS 36. So hopefully we would look at, and we're going to look at some past questions, some of your ICANN past questions. We're going to solve them in class. So that will take us like an hour. When I'm done with that, then we would have to move to IFRS 15. I want to do IFRS 16 leases, no, because these are topics I want to start, like when your mind is open from the beginning and just. So I'll probably take you IFRS 15 on leases. Then I have to finish that same day, God helping us. But yeah, IFRS 15 on revenue from contract with customers. Okay, so that is that for today, which is the first week in September. I will be seeing you guys again in the second week in September. The reality again is that we have around seven classes to go. So we're going to be meeting 7 more times because I'm not going to teaching you in November. Never. I'll end my class in and I will end my class in October. So practically, there are certain key standards I have to still teach you, like this IFRS 15, very important. IS 21, very important. Which one again? IFRS 16, very important. Those are very key, and also IFRS 8, very important. And there are some sundry standards that I might and I may not teach you, like maybe IS 10, IS 24, those ones. Maybe I'll ask you to read that, and I might teach you depending on what we're able to do with our October. Because what I've slated for October is ratio analysis. I know that some of you that are doing case study, they will have taught you financial analysis. Some of you that are doing SFM, they will have taught you. They teach you ratio almost everywhere. So we'll review it. Majorly, I would focus on past questions so that you would know how they set questions on ratios in corporate reporting. And also October, we would be spending most of our time learning about beyond financial reporting, where we'll be learning about sustainability reporting. We'll be learning about integrated reporting. And majorly, I'll teach you the principles using MTN financial statements. I saw their sustainability reports. It's excellent. So I'll use that to just demonstrate the principle to you, just for you to see that it's applicable, that people are doing it already. And for integrated reporting, I'll use Dangote report to show you how integrated reporting is prepared. So, and some other reports like that, corporate governance reports, risk reporting, those are theory. So these are things we'll sit down in 2.5 hours and cover. Fortunately, it's 20% of your syllabus. Surprisingly, last day they didn't even ask those parts at all. We are expecting that they will ask them this diet. So let's see how it goes. We have interesting weeks ahead for us here. So, and every topic we cover here is extremely important, especially this note that I send it to you guys every week on my part. And you just need to read and revise them over and over again. And I've not really been sending you guys assignments. So I would send more of that because I'm rounding up on accounting standards. So I'm doing a collation of relevant questions on each of those topics, at least 5 additional questions on each topic. I'll be sharing it with you guys as part of the materials you would get from us from Equity. So 5 questions for each of those standards additional. Hopefully, one of them you can find it in the exam. Put the question there, put the solution there for you. Practice them over and over again to help you on all the topics I'm teaching you. So let's see how it goes. Let's see how it goes. It's not far anymore. It's not far. So the period is so close. So let the time we spend together count, and hopefully we'll do well at the end of the day. So thank you very much and have a wonderful night. Bye.